Hi, my name is Jeff Fowler. I'm the president of the Apartment Owners Association. It is so good to have you with us today. And all right, we got all the technical stuff squared away. And today we are going to get an update on the proposed tax policies that might impact 1031 exchange. So that should be really good today. We have other live streams that are coming up on November 4th. That's next week, I believe. Yeah, next week we're going to go over how to prepare for small claims court, because a lot of you, starting November 1st, will be able to take people to small claims court. And so if you're in the unfortunate situation where you need to do that, you'll want to watch that video. It's Franco Simone. He's one of the attorneys down in San Diego, and so that'll be good. That will apply for everybody in the state, and so that'll be a really good one. And then we have a bunch of other ones coming up. How to help repeal the death tax will be coming up. We have one on renters insurance and why that's something that you want your tenants to have. That's coming up as well. So you'll want to subscribe to the YouTube channel, or you can subscribe to the e-newsletter that we have, and that will just keep you informed. The e-newsletter is way more comprehensive in the sense that if there's law updates, you're going to hear about it. You type in your zip code so you get things that are appropriate to your specific location. And anyway, so with all that said, if you're watching from the AOAUSA.com website, there's a blue help button at the bottom. And so you'll want to click on that and type in questions that you have about 1031 exchange. I'd wait to hear everything first and then ask questions, because they may answer your question just as they go through their presentation today. And this event is sponsored by H&S Wealth. They focus on 1031 exchange investments, and they've been a partner. They've been a advertiser here with AOA for over 20 years. We have a great relationship, never had a complaint on them. And anyway, you'll want to take a look at them and do some research, but they are definitely a good option for the 1031 exchange. And this is also sponsored by AOA Commercial Brokerage. Actually, the brokerage was established before AOA was established. And so we've been in business for 40 plus years, commercial brokerage. And if you're thinking of selling, then definitely give us a call. You'll get a free property valuation, and if you're interested in selling. So definitely think of us when you're thinking of selling, if it's the right season for you. So our first speaker today is a former USC football player and graduate from there. And so he knows what it's like to play with excellence, to do something with excellence, because he's done that. And since 1982, he's been a commercial broker. He's been with AOA since 2001 as a commercial broker. And it's my pleasure to and this is the other thing. Yeah, okay. I'll just go for it. Yeah. If you want closed caption, please go to Facebook. I totally forgot to announce this. You can go to Facebook, and it's closed caption now. After the recording's over, even YouTube has the closed caption. So just wanted to mention that. So bad timing, but here is a great guy, Greg Marderian.
Jeff, and thank you for being with us this morning. Before commenting on the rental and the investment market, I'd like to just remind us of what our categories are when we think of multifamily residential. We think of prime property versus affordable. We think of newer versus older. And we think of non-rent control versus rent-controlled property. Increasingly, the third category, rent-regulated versus non-rent regulated, is increasingly important in evaluating your situation, or if you're a buyer, your prospects. Overall vacancy in the LA Metro, about 3.8%. That's historically low. What is not being counted are delinquencies. If you're an owner, you're probably aware that there are delinquencies, and depending on your situation, I have heard from medium to larger owners a 1 to 7% delinquency rate. They're not being counted in that 3.8 vacancy factor. The rents have increased. LA metro area rents have increased to about 5.8% from pre-pandemic rents. Rents are actually higher, marginally higher, 5.8% in the LA metro area than they were pre-pandemic. Nationally speaking, rents are up about 10.8%, almost twice the LA metro area increase this year. The sales activity is now equal to pre-pandemic activity. 2021 volumes are equal. This trend developed in earnest fourth quarter of 20, and the market, I think, is as described as robust is a fair statement. Pre-pandemic pricing for rent-controlled property, we are at equal to pre-pandemic pricing for rent-controlled property, 5% plus or minus, but very close to pre-pandemic prices for rent-controlled properties. Non-rent regulated properties, AB 1482, those properties have seen about a 10 to 20% increase over pre-pandemic prices. There is a clear premium for non-regulated buildings, non-regulated rent-controlled buildings. I'll give you some guidelines, pricing guidelines. Largely, these are correct. There will be obviously exceptions, but cap rates mid-3s to high 4s across the board, depending on location, condition, and rent structure. Mid-3s to high 4 cap rates. If you prefer to use a GRM indicator, using 12 to 16, I know this is a broad range, but there are a lot of different kinds of buildings and a lot of different locations. So depending on location, condition, and rent structure, GRMs 12 to 16. Regarding taxes, it appears the 1031 and the stepped-up basis are not going to be eliminated. This is still in process. You'll want to follow this if you are a family operation. You want to be aware of the stepped-up basis. You want to certainly be aware of the 1031 in any case if you're an owner, and you want to be aware of capital gains. Capital gains will go up, but I believe the 1031 and the stepped-up basis at this time appear that they will survive. You'll want to monitor these things, though. It's in development right now. The biggest headwinds, in my view, to this pricing structure that we have today, which is a historically high, without any debate, historically high prices. The two headwinds we want to be aware of are interest rates, which will go up. It's almost undeniable that they have been artificially suppressed. They'll go up marginally. The question is, how much will they go up? If they go up 0.5%, no problem for pricing. If they go up more than 1%, it becomes a drain on cash flow for the buyer and will certainly be a headwind. The other headwind I see is government regulation. And the regs have impacted, if you're an owner, you know, eviction moratorium, rent control. Some cities are not impacted as much. They're governed by the state AB 1482. Others, like Los Angeles, there's heavy regulations. So that is increasing or maintaining those regs are a headwind, in my view. If you're an owner, you understand this. If you're a buyer, you need to understand it. I was hired by CBRE, then Coldwell Banker, in 1982. I've observed 40 years of commercial real estate, and my observations have been quality residential and quality industrial real estate have been the most resilient and most stable property categories. Housing and quality industrial real estate have weathered better and have had better returns, stable returns over the last 40 years, without question, in my view. I am bullish on DSTs for 5 reasons. And Adam will address these things, but I have sold triple net, and I believe there's too much concentration into the single property, a single tenant. We all, where is Sears now? Where is Kmart? Where is Blockbuster? Where is Penguin's Yogurt? You could go down the list. High-flying retail operations, Home Federal, the bank, high-flying retail operators who no longer exist. I think the concentration of wealth into a single triple net deal is a riskier proposition than spreading risk over housing. And DSTs afford institutional property. These are 100 to 300 unit, sometimes larger properties, institutional grade. The competition for them is severe. There's a shortage of well-located properties. Institutions are buying them at high rates, high prices, low cap rates. There's institutional management that is transparent. I'll let Adam address that, but the management is professional and transparent. 4.5 cash-on-cash returns or more, and depreciation is available. I think the diligence packages are excellent. I've seen these. For the savvy buyer, he can analyze a property. You just want a growth area and a quality property. And examine the diligence packages. I think these are suitable 1031s and the best option in the market if you're a potential seller. If you are a seller, it's a deeply personal decision. I respect that. You will know when you're a seller. It may be hard to admit, but you will know. If you want further information, I'd be very pleased to give you additional information with specific information as to your property or more market information. I appreciate this time today, and have a great day. Mm-hmm.
Thank you very much, Greg. I appreciate that, Jeff. It's wonderful to be here at AOA. We've had, as you heard, a very long relationship, and the membership, there's just a natural fit with the brokerage group here at AOA, the general membership, and what we do. So my name's Adam Bryan. I am a financial advisor. My focus for about the last 19 years really has been on 1031 exchange replacement properties for investors. Before you can even consider a Delaware statutory trust or a DST property, a replacement for a 1031, you have to decide whether or not to sell your property. And I think Greg said it beautifully. It's a very personal decision, and you'll know when it's right. I do know many investors feel that they should be selling perhaps when the market is hot, when there's a lot of buyers, but perhaps it's not the right time. Or conversely, in a down market, maybe you want to get out. You're done, even if you're making less money than if you had sold previously. It really depends on your circumstance. We'll talk about where the market is at, because that's a different question. But it's something we discuss with our clients. Just briefly, we're hearing in the news so much about this American Families Plan, this reconciliation bill, and the biggest news for my industry is what Greg already mentioned, and that is it appears that 1031 exchange, any revision or modification, several were proposed previously, has been removed from what is referred to as the markup of the bill. No matter what you hear from anybody, myself or other pundits that are out there, nobody knows anything until it's actually in black and white and in print in that written bill and on the president's desk, assuming it passes Congress. So that hasn't happened yet. We're all waiting. But there are inside tracks. People give reporting. Senators make comments. I'll tell you just briefly, before I go into the Delaware Trust, what we do know, again, tentatively, and that is the step up in basis in 1031, which there was discussion of revising, has been removed from the bill. If you are in the top income bracket, which right now for ordinary income is 37%, most likely you're going to go to 39.6%. That'll be the new top bracket, and that's if your income is over $500,000 a year, your ordinary income or adjusted gross income. If it's over $5 million, first of all, congratulations. The bad news is you'll have a 3% surtax on top of that 39.6, so 42.6 will be your new top bracket for income above $500,000 in a given year. Capital gains, the maximum right now, if you're in that high income bracket, is 20%, 15% typically for most investors, but you can be up there at 20. They're discussing revising that upward to 25%, so making the pain of cashing out, if you will, and paying the tax even higher. Corporate tax is right now at 21%. That changed 2 years ago pretty dramatically. And there is discussion now, this has again been revised over time, to increase it to 26.5% for corporations. Now that's if you own a corporation, obviously, but it also impacts the average consumer, since businesses tend to pass their expenses on in the form of price increases. So that's what we're looking at. Good news if you want to exchange, you're keeping all your options. Not terrible news if you want to pay your tax and cash out. Unless you're in that very large income bracket, you may be paying 5% more in taxes. So as I was talking about, let me kind of move ahead here. Whether or not you sell is a decision each investor has to make based on their personal circumstances. And I'm not going to tell you that you should sell. It's not my job. I really just want to help you accomplish whatever I can that meets you and your family's goals and needs. Now, where we're at in this market or in this cycle is a very different question. And what I can tell you, as you see on the bullet point there, that we've seen an increase in Los Angeles County. This is from a study that was done a few years back between 2000 and actually 2017. Average rent adjusted for inflation increased 30%. So if you were paying $1,000 for a studio in Hollywood in the year 2000, in the year 2017, you were paying $1,300. And in fact, I'm sure it's gone up a little bit more since then. Incomes in that same period in Los Angeles County, again adjusted for inflation, you would think that they'd risen. We're talking 17 years. In that time period, they dropped 2%, the average take-home income, again adjusted for inflation, so equal dollars. So what does that mean? People in Los Angeles County, renters specifically, are earning the same or less money. It's risen a few points, so I think we're about even now in 2021. But they're making about the same money that they made in the year 2000, but they're paying a third more for Los Angeles rent. Now that's great news as a landlord. And if you keep up with market rents, if you manage your properties and maximize the potential, you're going to not only generate more income, but create more value. You heard Greg talk about cap rates and gross rent multipliers, GRMs. Well, the better you're able to produce on those, the higher the value of the property. It also means that renters are paying maybe not as much as they can pay, but at the top of the market, they're paying a lot of their disposable income, their take-home pay. How much more rent can we charge as an industry? When you get to that perhaps breaking point, max point, same thing is true of selling property and what the buyers are willing to pay. You do reach a ceiling at some point. I think we're close to it. You've heard Greg talk about the numbers. I can tell you from my experience, investors are having fantastic returns when they're selling in the recent months, even through COVID. So arguably it is towards the top of the market. I hate to call anything, but we're bumping up against it, unless incomes go up, which could happen with inflation. But where we're at now, it's looking like we're towards the top of the market. By the way, that doesn't mean we're in a bubble. A bubble, to me, what's inside of a bubble? Air or nothing. And what we saw in 2009 was the exposure that so many of the properties that had transacted were bought with leverage, which wasn't held by the bank. As you know, it was sold on Wall Street as a bond, and it created a whole lot of nothing when the time came to roost, if you will, and the loans came due and the properties had to sell. They weren't holding value, and of course we saw that ripple effect. Nothing like that is occurring right now. Banks are requiring a whole lot of information before they make a loan. They are lowering the amount of leverage. Leverage is really key here. They're not lending 90 or even 100% on homes like they were. Maybe you can get 70% on a rental property that you're financing. Talk to your lenders. The point being, there's a lot of equity. In fact, there's a lot of all cash purchases that we're seeing as well. All of this bodes well for the real estate values. People are, even through COVID again, they're higher income people, I should say, are paying their rent, and the properties are holding their value, and they've risen steadily. Going back to the slide here, what options do you have when it comes to this decision to sell or not? Well, let's say, your first and most common one is I'll pay the tax. They are going to figure out your adjusted cost basis. I won't walk you through the formula, but it's basically what you paid originally for that property or the prior properties if you exchanged into it, reduced by depreciation, increased by improvement. There's your basis number or adjusted basis. If it's $200,000 and you sell the property for $1 million, that's an $800,000 gain. In that example, everybody's taxes are different, but I can tell you from, frankly, 19 years of experience, that $800,000 gain is going to be taxed at around $250,000, essentially a third of that capital gain ends up in federal, state, or recapture taxes. The other option is you can go buy another property, and that's a great option for many investors, many people. The problem is if you're selling in a good solid market, like I would argue we are in Los Angeles County, you don't want to be a buyer in this same market. So consequently, you're always faced with that issue and that dilemma. And you can go out of state where obviously the prices are lower, but there's a lot of folks that don't want to be absentee landlords, and that's an issue and a concern, owning a rental condo in Phoenix or what have you. It can work for many investors, particularly younger investors or people that have time and the ability to manage, but it's a challenge. And for most people, in my experience, that's the end of the story. They don't think they have any other options. Well, back in 2004, the IRS issued what's called a revenue ruling on something called a Delaware Statutory Trust, a DST. A DST is a form of co-ownership, fractional ownership, not like a timeshare, not like a partnership, a true co-ownership of institutional property, like you saw there, big apartment buildings, multi-hundred-million-dollar assets. Can be commercial, can be all types of real estate. It all qualifies. It's really just about the format that the property is bundled, if you will. But the IRS said in 2004, if you exchange into a DST interest, it qualifies for 1031 exchange just like any other real estate. Now let me explain how this works. It's a great option for folks, I like to say, who need to own real estate without owning real estate. They don't want to necessarily deal with the day-to-day management hassles. By owning a small fractional interest in a very large institutional property, that takes away the hassles of property management, but gives you the benefits of 1031 exchange and ownership of real estate. I'll explain how that works. But how does it work in general? A sponsor company, not H&S Wealth Management, but a real estate company, management company, an acquisition firm, they'll go out and scour the country to try to find good quality real estate. That's their job. And they can buy any type of real estate. Generally, they'll buy anywhere in the continental U.S. We at H&S, and Greg, I think, spoke to it as well to repeat, we like high-end or Class A quality multifamily apartments and self-storage and some industrial as well. These asset classes have held up the best historically. We've seen that. We've been through the Great Recession, and that's where we tend to recommend our clients reinvest and diversify their equity. The sponsor company forms a legal entity, a Delaware statutory trust. They will acquire the property with their own money, arrange financing, assuming there's a loan on the property, and sign any guarantees required on the loan, and then own the property and operate it. They act as the manager. At this point in the story, they're the sole owner of the property. The DST is, but they're the sole member, I should say, of the DST. They then go out to what's known as the independent broker-dealer network to raise the money that they put into that property and pull their equity back out and sell off interests, fractional ownership interests. This is done through the securities world, not through the real estate brokerage world, requiring financial advisors, licensed individuals, to sell these properties, these interests in these DST properties. They are not allowed to be generally promoted. That's why you don't see me showing you some current offerings today. They're not advertised generally. You can, anything specific to an offering has to be, it's known as a private placement. You have to be an accredited investor to even see one of the offerings and invest in them. Accredited meaning you have $1 million net worth, excluding your home. And that's why many investors, I find, aren't familiar with the Delaware Statutory Trust. It isn't that you're not knowledgeable or savvy as a real estate investor. I find about 1 in 10 people I talk to has actually even heard of it before. But it is not new. It has been around and blessed by the IRS in 2004. I don't know the exact numbers, but there's been several thousand DSTs that are operating around the country and have been for many years, and many have also sold, gone full cycle. Some of the advantages of a DST, first of all, the lenders love this structure because there's a single borrower and a single buyer. It's this legal entity. Any guarantees that they need, any signatures, the sponsor is the trustee of the trust and will sign those. The leverage we talked about earlier is very conservative. I would argue 50 to 60%, or even below 50 I have seen. A lot of equity, a lot of cash is going into these deals. The negative of that is it reduces your cash flow return, your percentage of return. The more debt you use and the less cash you put in, the higher your cash on cash return. The good news is there is so much equity in these properties that, again, it's very unlikely that the property would go into default and go back to the lender. It literally would mean the property would have to lose 40% of its value, which even in the Great Recession was fairly uncommon on an average basis. Back in those early mid-2000s, we were seeing for these institutional properties 60 plus always, 80% even, which is considered very aggressive. Normal for a home, a residence that you live in, but 80% loan to value on an apartment building is pretty aggressive and even higher in some instances. And that's what led to a lot of the demise of the economy and the real estate market. Well, we're not seeing that now, and that's, to me, a good thing. The sponsor will sell off interest, typically to 1031 exchange investors. I think that's important to know. These aren't, that is to say, you can invest cash or direct investment in a DST, but most typically they're designed for folks that are selling a property, have a big capital gain they want to defer. That's the ideal market. You receive 100% pro rata share. Now, put simply, that means if your equity, your investment in this DST represents, let's say, 1% of the equity being raised, which gives you 1% ownership of that real estate asset, technically of the DST that owns the asset. But what's important is that 1% in my example, you will receive 100% of your share of everything. And by everything, I mean the disposable, distributable cash flow income, the expenses, which are put on your Schedule E on your tax return. You get 1% of your share. You can claim 1% of the property on your depreciation schedule. Everyone's different, but 1% of the property is yours. Everything is meant to flow through. You're not diluted in any way. Many partnerships, some of you may be thinking of 1980s perhaps or later partnership structures. Many times the sponsor or the syndicator would take a portion of that interest. It might be the cash flow, it's definitely the appreciation, could even be the taxable deductions. Well, they're not allowed to do that in a DST. The IRS was very specific that they didn't want to see that kind of dilution. So I always say this is very much a structure like you and I go buy a property 50-50. We each put up half the money. We each take half the cash flow and share in the expenses on our own tax returns because we're not in partnership. Maybe we're tenants in common. When we sell the property, whatever that appreciation is, we split 50-50. That makes sense to everybody, and that's a simple example. Now, multiply it by potentially 499 people each owning their share. Not 50%, but maybe even less than 1%, right? That's how a DST is structured. And in fact, 499 is the maximum number of investors allowed. I mention this not because you're in partnership with these other investors, and there's usually about 100 in the average DST, by the way, but because it creates the ability to have a very low minimum investment. If you have 500,000, then you're limited in what you can buy, period, in general. In Los Angeles, you're going to need probably quite a bit of debt if you're buying an apartment building. But in a DST with 500,000 in equity, you're able to purchase potentially 5 different DSTs in 5 different states with 5 different sponsor companies. That's entirely possible. It gives you the ability to diversify your investment that you wouldn't find in other offerings because, of course, you're owning a fractional piece of these different properties. And typically that is what we recommend, maybe more like 2 or 3 with 500,000, but it all depends on you and your circumstance and what you're trying to accomplish. Again, the best thing about these investments is the worst thing, and I would argue it's the same thing, and that's the ownership control. We're used to managing our own properties and buying them and selling them. That's very typical of the clients that I talk to, members of the association here. That can be a good thing and a bad thing, right? If you're taking care of it, you're confident that it's being well run, you're increasing rents when you choose, you're deciding when to sell, like we talked about earlier. But on the other hand, you're also dealing with difficult tenants. We just went through a very difficult period, as we all know, with COVID, repairs, damage to the property, delinquency, eviction, all of the negatives associated with owning real estate. While there's great rewards, it also comes with a lot of effort and what they like to call sweat equity. In a DST, you do not have to do any of those things. You're not responsible to manage the property. You're leaving it to an established, credible company that has literally thousands of units under management, so they know how to most effectively manage these properties. You have to be comfortable with who these firms are, of course, before you entrust them with your equity, but that's part of our job to kind of help you understand who they are and what their background is. Question that I get is, when is this thing going to end? How long is the hold period? And typically the answer is it's about 7 years historically, and I do think we're going to be roughly around that average moving forward. If you invest today, probably the property will sell in 7 or 8 years. The reason I say that is because we're towards the top of the market in DSTs, just like everything else. And that means it's just going to take longer to appreciate in value to make the investment worthwhile and logical to sell. Right now, we're involved in many DSTs that are selling that were actually invested in only 5 or 6 years ago. So a relatively short hold period, and the reason for that is the market demand is there. It's a good time to sell for a lot of these DSTs. The ones that we're buying, of course, we're arguably paying more in many markets than we would have 5 years ago, but that just, again, means it may be a little bit longer hold period, operational period. Some investors want it to be forever, some want it to be a quicker, shorter term. The sponsor is going to decide what maximizes the return for the investor and where the market is at, what they could produce, what kind of return. Other question I get very typically is about liquidity, about getting out. What if I want to sell my interest and pull my money out early? Can I do that? And the answer is a little complicated. I'll try to be as straight with you as I can. The direct answer is yes. You have the ability, the right, the legal right to sell your interest 2 weeks after you close your DST interest, or 2 years into the hold period. That being said, it is not recommended, and there is no secondary market. There's no structure where you can go and say, I want to sell my interest. So you really should be investing in these things, considering that 6, 7, 8 year period. Generally not going to go beyond 10 years. But that being said, you have the right, the ability, and you choose your price. There is a built-in structure in DSTs where if an investor, let's say there's 100 in a DST interest, wants to get out, maybe not even all their equity, maybe you just want to sell half, you have a need for capital, or another opportunity, you can, the sponsor will offer, make other investors in that same DST aware that there's an investor who wants to exit, because you don't know each other. As I mentioned earlier, you're not in partnership. You each own your separate interest and the sponsor takes care of the asset. But if somebody wants to exit, the other investors are made aware, the ones in this specific DST, first. They have a right of first refusal. And that just means that they get an opportunity to make you an offer. And again, you decide whether or not you want to sell. If you do, if you get a price, you come to terms, I can tell you it's a very simple, quick transaction. It's not actually a normal real estate deal. There's no loan assumption, title, escrow, appraisal that's done. It's actually very smooth and effective and inexpensive. But I don't say that to encourage you to try to sell early, because again, there is no assurance that you'll find anybody to purchase your interest or that they'll pay the price that you want. If you're not able to sell, if you're able to sell, you may do an exchange out of your interest. The funds would just go to an accommodator like normal. If you're not able to, you can try to go to the open market, which is to say, list it somewhere, talk to me. But again, there's no individual marketplace where you can go to sell those interests. So it's encouraged to be thought of as a illiquid asset, which, by the way, the government considers all real estate illiquid. It's not daily traded on an exchange. So that's the exit. It's possible. I can tell you from many years' experience, in good times, it's actually relatively easy. And in bad times, it's relatively difficult, kind of like the regular real estate market. Next thing I want to cover are some reminders, and they're reminders of things that you already know. I know that because you're most likely a landlord and a member of the association. You know real estate, and you bought probably in Southern California, and that was very wise, whether it was last week or 50 years ago. I think you made one of the best investments that's available, period. First thing to consider, certainly who I am, who H&S Wealth Management, we want you to be comfortable and know who we are and look into our backgrounds. But that sponsor company I've been talking about, there's about 5 or 6, 7 that we work with that are out there. There's actually I have 30 plus, but I think we're approaching 40 now, companies out there, sponsor firms, that do all kinds of different real estate, structured as DSTs. But my business partner, Bob Horning, and I at H&S, we like to focus on folks that we already know personally, in most cases, that we already have experience with, and we already have literally hundreds of clients working with. And that narrows down the group, and certainly all the new folks that have come along, they just don't have a full cycle track record. Full cycle is a term we use for the company bought the property, sold DST interests, operated the property for some number of years, and then sold it. And we can then compare what the appreciation, what the return was. We want to see that before we introduce you to a sponsor. Makes us comfortable, and of course, in turn, that should make you comfortable. The other thing is, I notice people forget it's real estate. You know, it's this $200 million property that you're investing in, and you know, it seems like a stock or something other than real estate at that point. And it's not. It's still real estate, and it does carry real estate risk. There are no guarantees, but as they say, death and taxes. What you can do to mitigate your risk is buy recession-resistant properties. If you're concerned about inflation, which we're hearing a lot about, multifamily, self-storage, any multi-tenant with relatively short lease term assets are good investments, good hard investments in inflationary times. Why is that? Because if we hit an inflationary time, it's a little bit like a rising tide. That means that incomes and rent, as well as dividends and interest rates on bank and CD notes rise, along with prices. And of course, when you get out of whack, that's when we have a problem. But in multifamily or self-storage, usually after a 6 or a 12-month term, you go month to month, and you're able to bring in new tenants as old tenants move out at a much higher rate, assuming the market rates have risen. You can keep up with inflation. And that's one of the reasons that we like these two asset classes. The other thing are the 3 golden rules that we all learned about real estate, and we all know. But again, it's a reminder. Where is this DST interest? What are the 3 rules that we learned? Location, location, and I always forget the third one. Clearly, location is incredibly important. It's not just the building. It's not just the tenant in the building. Maybe it's a Walgreens, which has good credit right now. But that being said, if Walgreens moves out at the end of their lease in this commercial property, hypothetically, you now own the building. And where's that building? It may be in a place that other tenants don't want to be. Clearly, Walmart, in my example, doesn't want to be there. And you may be stuck holding a property that's very difficult to release. The other thing is the age of the property. There's opportunity in the oldest properties and in the newest, but generally you're able to be more protected from any issues that you're going to have on the property, any capital that may need to be contributed for things like, let's say, the roof, which generally has a 10 or 20-year warranty, but after that point, you may need to replace it. Restriping parking lots in a big apartment building is often an issue. Redoing the fascia, the outside of the building. All of this is mitigated if you're dealing with ideally a new property or a property with, let's say, less than 10 years of age. They just need less repairs. You have things like warranties on appliances in an apartment building that are usually still active around 5 years. These kinds of things point to probably buying newer, higher end, high income rents Class A real estate is your best bet in my view and in my opinion. The demographics, meaning where are people moving to, and are they moving out or in at a greater rate? Is it a large market or a very small market? And most importantly, are the jobs going there? People follow jobs. Generally, that's the pattern. And we are able to look at a given market and certainly look at where they've been in the last few years and where they're projected to be. Lastly, I keep mentioning Class A, and really what I mean is that you want high-income tenants that are young professionals, lawyers, accounting, what have you, maybe even people who make enough to pay a mortgage, but either they don't want to own a property, which is becoming more and more common these days. Maybe they don't have good credit. Maybe they're just not able to save that 20% down payment that many lenders are requiring. Or maybe they just want to be able to move when they choose to. That's become much more common as well. People are more mobile than they have been in years past. Nobody stays at a company for 20 years anymore and collects a pension. I mean, it happens, but it's not the standard. Nowadays, people change jobs and homes every 7 years. So again, having those type of high-end tenants ensures more security as far as collecting your rent and maybe even mitigating less damage to the property. I can tell you I never dreamt of the pandemic happening in the years past, but what we saw through the pandemic with these types of assets is surprisingly little impact. Most of those tenants have jobs that they can do remotely. They're not face-to-face employees like hairstylists, bartenders, factory workers, a lot of folks that had to stay home but couldn't earn a living. Our tenants generally were able to work remotely with technology being what it is. So it tends to mitigate that risk. So these are the main things I encourage folks. We'll talk about a specific DST if and when you're ready, but those are the ways that I'm going to kind of position it. Lastly, as you see up here, if you want to see what a DST looks like, or you want to talk about what your options are, or even what your tax consequences might be if you cash out, we're not accountants, but we can certainly tell you what we think might make sense for you and your family. Please reach out to us. You can reach out. I think you've seen my direct line a few times on the screen. That's our toll-free number. That's our team, myself and Bob Horning, who you may recognize, and our support staff. Thank you again for Jeff and for everybody here at AOA for this opportunity. I'm going to hand it back, and I think we are going to do a little Q&A.
Great. Thank you, Adam, for sharing. And if you are watching and you have questions, please go ahead and put that into the chat. And then we can get those, they'll get those questions to me so we can have questions both for Greg and Adam. Either one of them can answer questions. And anyway, if you, so we'll go ahead and we'll take questions. And this is, here's Batul, and she views often. And her question is, what is the threat to the 1031 exchange?
That is an excellent question. I've been following this. About 95% of my company's revenue is based on 1031 exchange investors. We really are specialists. And as you can imagine, if something dramatic were to happen to 1031, I would want to know about it. So I followed this extremely closely. Let me give you just briefly the history. So during the campaign, the presidential campaign, Biden had proposed anybody earning more than $400,000 in ordinary income or adjusted gross would not be able to exchange at all. Pretty dramatic change in our system, and the initial thinking was maybe this will create more tax revenue. And the truth is there aren't many, even very wealthy individuals that earn more than $400,000, but they may in a given year, especially if they are cashing out and selling an asset that's highly appreciated. And that was the company line, if you will. That was the written tax proposal. It was on the campaign website. Not until he was elected, President Biden, and into April, as we went through the first bailout with COVID, did he revise really anything in his initial tax plan. I will say, whether you love him or hate him, there's been a real consistency on what he's been trying to do, and obviously needs the Congress to accomplish most of it. One revision was, he said in April, with this latest reconciliation plan, American Families Plan, why don't we say that you can defer up to $500,000 in taxable gain, not sale price, profit, and then everything above that you have to pay tax on, whoever you are. And let me tell you, in my humble opinion, this was a horrible idea. It would affect many, many, many transactions and many Americans. particularly in Los Angeles County because of the value of our real estate generally. So that was then the company line, if you will. He also mentioned various and sundry other tax things I won't go into since you asked about 1031. The latest markup to the American Families Plan, again, this is the document where they're negotiating and doing the vote-a-rama, and meaning the Congress people are negotiating. Ultimately, what they seem to have settled on, as I said at the top and Greg said in his talk, they decided not to touch either the 1031 exchange or the step-up in basis, which means you can now, just to reiterate for those of you that aren't aware, defer 100% of your gain when you sell your real estate, as long as you do a few things. You have to buy investment real estate held for investment purposes. You have to identify what you're going to buy within 45 days. You do not get a lot of time. And you have to send your funds when you sell your property to an accommodator or a third-party intermediary. But if you do those things, whether you invest in your own real estate or a Delaware statutory trust through us, it qualifies and you're able to pay zero taxes. And I mentioned step up in basis because, as many of you may know, the way the tax code is now, if you pass away and you own a hard asset, let's say a real estate asset worth $1 million, and it goes to your son, on the day of your passing, there's a calculation of what the value of the property is. Let's say it's $1 million. You may have paid $100,000 many years ago. You had a $900,000 gain had you paid the tax. But you didn't. You did the right thing and you died. And in that example, you're able to pass it on to your heirs, in this example to your son, and his cost basis is now $1 million, not the $100,000 that you paid. So your basis dies with you. That's called a step up in basis. It happens with hard assets, real estate, with investment stocks. That's the way the structure is now, unless your portfolio and your whole estate goes above the way the law is right now, 22 million. Another proposal is to lower it to 11 million. If your estate is worth that, then a federal government inheritance tax kicks in. But forgetting that, that's been the threat, that's been the concern. And I can tell you again from years of experience, this has come up 2 other times. This is the 3rd time where it was almost reaching a bill eliminating 1031, because people think, oh, why don't we just not let all these investors defer their tax and we'll suddenly generate a lot of tax revenue. But when they study it, and they literally have, my trade association hired Ernst & Young, big accounting firm, to do a study. When they look at it, what they find is that, first of all, most people end up not exchanging until they die. They actually end up paying the tax. It's kind of surprising, I know. It's actually at 85%, it's estimated. So really you're only chasing over a period of time 15% of the taxes that are being deferred upon death with the step up in basis. That was the first thought. The second was, well, if we told everybody you have to pay your tax, and it could be 1/3 of your gain, as I mentioned earlier, what are you going to do? Many of you are not going to sell. You're just going to continue to hold. Maybe you'll refinance if you need a big chunk of equity. It would actually produce less taxable income, ironically, by eliminating 1031. Under President W. Bush, Obama, and now Mr. Biden, every time it's been looked at, Congress never even gets it to the floor, never makes it into the bill, because when you really look at it, it doesn't make sense. And I know our Congress doesn't always do things that make sense, but in this example, I think we all tend to agree. So to be honest, you've heard me up here, if you've watched any of our other talks, talk about that this could happen, we don't know, and that's still true. But historically it hasn't, it's illogical, it doesn't create much tax revenue at all, if not, maybe even hurts it. So that was what the threat was elimination or a cap or various and sundry other ideas over the years.
Now, when do you think we'll know I guess you have a 4-year period as president.
Right. Well, and
so it's on the books there. Is there a date that you're looking at that you'll be able to say, yeah,
we finally heard?
Yeah.
Yeah.
When's the next update? That's
a great question, Jeff. It isn't so much the 4-year term of our president, but the 2-year term of our Congress, because again, this has to pass Congress. Right now, the Democrats can only do it with a single vote from the vice president, and I think 10 or 13 votes in the House of Representatives. The answer is only once a year can you use this reconciliation, this tax maneuver, on anything that affects spending or taxation. This was passed in the 70s, which most folks are surprised to hear that, because nobody used it up until really until the 80s, and now it's become almost every year, it seems, in the years 2000s. The answer is, as long as the Democrats hold the Congress, every fiscal year, not calendar year, they're able to implement one-time reconciliation. The first one was already used, interestingly, and that was for the year 2019 to 2020. It was actually President Trump's last year in office, did not pass a budget. So in other words, in the 2 years the Democrats hold the Congress starting in January of this year, they actually have 3 opportunities. The first of the 3 was already used back in January with the first COVID bailout that passed. That passed through reconciliation. The next one should happen, although they can always extend, as you've heard again in the media, when we need to get a new budget and raise the debt limit. Likely to happen in the coming weeks, I think, is a pretty reasonable proposal. Or I should say really by the end of the year. It's not a firm deadline, but it's very likely that they'll pass this current version, which is being called the American Families Plan, which will have those tax increases I talked about earlier and hopefully not touch 1031 or step up in basis. The next fiscal year, 21 to 22, will be another opportunity for the Democrats, as they still hold the Congress, to use reconciliation to do anything really that they choose that they can agree on. And then when the midterm elections happen, potentially the Congress could change hands and the power could go back to the Republicans, in which case there would be no opportunity. Last thing I can tell you about the American Families Plan is the goal is to make it a zero sum, meaning it's not deficit spending. Whatever they spend, it's been required that they cover it through tax increases.
All right, that's good information. All right, Francine on YouTube. How long do investors have to exercise their first right of refusal?
Oh, on the DST. That's a really good question, Francine. I can tell you it's a reasonable period of time. In other words, they aren't going to give you 5 minutes to say, do you want to buy or not? I can tell you most folks that have sold their interest in a DST early, before the whole property sold, did in fact sell to other investors, again, at a price of their own choosing. But to be honest, I can't recall contractually what that period is. I'm going to guess it's 30 days or somewhere in that 2 weeks to 4 week period. I'm sure it has to be a reasonable period of time. It's certainly not long enough that it would, make it difficult for somebody to sell outside the group. But I don't know the exact answer, but let's just call it a reasonable period of time.
Great. And here on YouTube, Lewis, if capital gains is 20%, if annual income is less than $500,000, does the sale of a $3 million property bump up the capital gains rate?
Yes, if that year you're claiming that income or that capital gain. So I think what you're probably thinking of is you're distinguishing between profit or capital gain versus dividend versus ordinary income, W-2 income. But the answer is, yeah, any gain that you take in a given year is going to increase your AGI or adjusted gross income, which could kick you up to the 20% rate presently. I believe it's $400,000 presently, actually. But as I said earlier, there's a proposal to make that top rate 25%. And just to make it even more fun, it isn't really 20 or 25 or 15. It's actually 3.8% on top of that because of the Medicare or Obamacare tax. So you're really paying most folks around 18%, 0.8, 23.8, and now potentially 28.8 capital gain depending on your income.
All right. All right, Rosalie on YouTube. How about try to sell it later? Is it hard to sell with share owner property?
Trying to sell it later. All right, I'm going to assume you mean, and let me answer the question this way. I suspect you mean, is it hard to sell the DST itself when the sponsor decides it's the right time? Generally, I can say the answer is no. Every market and every time period and every location is different. But as a general rule, as I mentioned earlier, thousands of these properties have been done as a DST, and hundreds have been sold, have gone full cycle. The question is, are you getting a good price or a good return, which is really what I think you want to know. Not only are you able to sell it later, but are you getting your capital back? Are you getting appreciation? Having done this so long, I can tell you that in the very difficult market of 2009, 10, 11, investors were often, breaking even or making relatively little on their return on equity. They paid $100,000 for the DST. They got maybe $102,000 back some years later. Now, there was cash flow during that hold period, so your overall return was better. But that was really what I would see, at least as far as the weaker performing DSTs, and often they weren't Class A multifamily. What I've been seeing in recent times, I almost don't want to tell you, and that's because I don't expect the next 5 years will be like the last 5 years. But I will share with you that we are involved right now in several DSTs, more than several, that are going full cycle, that are selling for anywhere from 120 to 200% return on investment in just 4 or 5 years. And that's a reflection of the market having risen. But as far as are there buyers, I think is really another way to pose your question. And the answer is yes. They tend to be institutions, big investment houses, hedge funds. There is a whole market of folks that buy these $50, $100 million properties. And the fact that they're a DST is a non-issue to the seller, to the buyer. That doesn't create any problems. In the old days, there was another structure, not a DST, but a TIC or TIC. And without going into a whole other seminar, I can tell you there were challenges sometimes dealing with TIC owners, but that's a non-issue for DSTs.
Great. And YouTube, Francine, again, is it worth it to fix a place up if you are thinking about selling? Greg, how about you answer this one?
Well, that's a pretty broad question, but I would think that it is always a good idea to maintain your property. And the government's going to be interested. If you're in Los Angeles, you have code enforcement. Your tenants will appreciate it. Tenants turnover will be lower. If you're talking about selling, again, yes, it's a condition of property is a very good condition. Property is a clear positive.
Great. All right. Well, thank you, Greg, for that. And that's all the questions that we have. And remember, next week we're going to learn how to prepare for those small claims court dates that some of you may have, and so definitely tune in next week. And also, I do want to mention that the price of an AOA membership is going to go up next year, starting January 1st. And I just want to give you a heads up. And even now, you can tack on 1, 2, 3 years if you'd like, and get the current price. And so you can go ahead and do that if you'd like. And also, there's the AOA property management software, and that is right now and through the end of the year at least. It is 6 months. The first 6 months is free, and then it automatically will start billing after that. So those are 2 different opportunities that you have that I want to make sure you're aware of. Oh, and it looks like we have another question here from Paul. And here's his question. Please go over the DST qualifying requirements, accredited investor and minimum investment.
Yeah, good question, Paul. Because it's considered a security by the federal government and the SEC, they deemed it to be a private placement or a Reg D offering, if you want to Google. But what it means is it's a private investment offering, not a public offering. And so therefore the government feels that only accredited investors, high net worth individuals, should be investing in them. And they've defined it as $1 million in net worth or greater. Before Dodd-Frank, after the Great Recession, you could count the equity in your home, but they eliminated that provision in Dodd-Frank. So exclusive of your home equity, $1 million in net worth, all your assets minus your debt, or greater. Or if you're single, you can be $200,000. If you're a married couple, $300,000 in the last 2 years of ordinary income. So you are able to qualify just based on income. For most of my clients in Southern California that own investment real estate, it's not an issue at all. The minimum investment stated in the offerings, and if I do share one with any of you, you'll see very clearly $100,000 is the stated minimum. But I can also tell you that they have the right, the ability, and will often allow smaller amounts of an investment, again, giving you the ability to diversify.
Great. Thank you so much for that. All right. So those are all the questions, and it's great to have the live streams because you can ask questions live. So next week we'll be asking questions live, and just about every week we'll have something for you. And we'll take a break during Thanksgiving and New Year's and things like that. But definitely want to just keep coming and yeah, just helping you stay in the know. And we want to give you at least one idea that's going to help you make and or keep more money. And DST, this is an idea, definitely an idea for you. And depending on where you're at in your and what you want to do, your life stage, this may be a really good idea. And anyway, thank you so much for joining us. We'll see you next week.
Thank you, Jeff.